gathered here today to talk about how financial failures reshape markets and strategies. I would have liked to have said that my third eye guided me to that topic 3 months ago when I gathered our speakers here to think and opine about how these things happen and how we should be thinking about them. But fortunately or unfortunately, it's a very pertinent topic. And I guess the interesting part, maybe the innovation of this panel today, is that when people think about financial failures and how those reshape the markets and strategies, they typically think about the visible part of the market, the typical market participants, the hedge fund managers, the portfolio managers, and so on and so forth. So the innovation here is that we're going a little bit to the darker, less visible side of the market, which though time and again has proven to be very relevant in the way that either crises start or crises propagate. So we have somebody from a central bank, we have somebody from the corporate side, and also somebody from private markets. And maybe that will give us some additional insights as we enter into this year. So what do I want to do and with whom? What I would like to do is get some context from these three folks from the past, because that's how typically people understand those things. Then move on to thinking a little bit about the architecture of risk and market failures, because ultimately when we deal with failures, we deal with them in real time, so we're dealing with the unknown unknowns. And the third and maybe most relevant question is what do these folks think about the immediate future? Because as I said now, it's a very pertinent time to be thinking about market failures. So who am I doing this with? As I said, three different sectors here. I'm going to start with Ms. Vicky Saporta, who is the Executive Director of Markets at the Bank of England, and thank you for taking the trip to come with us. Her main two areas of expertise and responsibility are monetary policy and financial stability. However, if you ever wanted to ask any questions about regulatory reform post the crisis, the global financial crisis of 2008. She was the person who was involved in that, front and center. And also, she is one of the key persons that formulated financial reform on the aftermath of Brexit. But that's maybe relevant after, if you can grab her right after the event. 28 years at the Bank of England. She has deep academic links still, and she's also, for those that know the relevance when we talk about crisis, the representative of the Bank of England at the Bank of International Settlements. Moving on to my immediate right, stage right, as they say, it's James Christopoulos from New York. He is the CVC Capital Partner with specialization in industrials and services in terms of sectors, and also very relevant, he has taken several investments in Greece. Very relevant also, actually not very relevant, but very important, at least in the way that I'm thinking of things, is so that you don't think that we are just the evil guys up here from the markets. He is the chair of the U.S. Philanthropy Committee at CVC for the entire U.S. Last but not least, Mr. Philippos Kassimatis. He comes from the corporate sector. He's the CEO of Maven Global. What he does is he's into capital markets advisory, dealing mostly with corporates, but not only, sometimes with semi-governmental agencies. And he also has very live academic links, so he has one foot on that space. Now, that short description that I gave, probably you understood about 1/10 of what they do. So as I move on to the first question, I would like them to actually use that opportunity to explain what they actually do as it comes to the markets. And I'm going to start with Vicky. And it's going to be a very similar question to all three of them, which is, as I said, it's about the past. So from the perspective of a central bank, how do failures shape future policy? And what are the lessons learned that, from your 28 years in presence as a central banker?
Yes, so central banks, what do they do? I mean, they set interest rates to try to control inflation. So that's monetary policy. But when they do that, they have a balance sheet which is actually my current role, that's what I manage, and they try to implement monetary policy through the way that they lend into the market their reserves, which is the money that only central banks can create. So that's one thing that central banks do. The second thing, which historically actually, because central banks, not all central banks got monetary policy independence immediately, the historical kind of purpose of central banks was actually to maintain financial stability. So what does that mean in practice? That means is to scan the horizon currently to try to identify vulnerabilities, to communicate those, and also in certain circumstances when the risks are really systemic to intervene, again using their balance sheet. So that's what central banks did. So I've been involved in all of this in my 28-year career. So what lessons have I learned in terms of financial failures? Well, the first one is ages ago, and it was 1.5 years into my career. I was quite young. I was a young analyst working in our financial stability area, much more beautiful than now. And then what happened was we had the first major, if you want, operation by central banks ever that involved a non-bank, because traditionally central banks deal with banks, not non-banks. And this was because a hedge fund, a very big hedge fund called LTCM, Long-Term Capital Management, got into trouble. And the Fed, the Federal Reserve, coordinated banks, basically, that had lent to that hedge fund to try to stop that hedge fund from unwinding its vast book, its vast investments, in a very disorderly fashion. So that was extremely strange at the time, because central banks, as I said, did not used to. And what had happened, what were the lessons? What did LTCM do? Well, LTCM used to try to profit from very small changes, basis points changes, small changes in terms of the difference between different instruments, imperfections in markets, between, let's say, futures and cash instruments. So arbitraging these differences. Now, to make lots of money from these small differences, you need to invest loads of money. Where do you get the money? You get the money from banks that lend to you. And in LTCM's case, they lent to them at a ratio of 25-1, which means from $1 of LTCM's equity, they would give $25 of borrowing. This is called leveraged. So the model was highly leveraged. Now, this fund had very sophisticated risk management. Amongst its founders were Nobel Prize winners in finance, for the time sophisticated. But the risk management models that it had were depending on historical data and historical correlation that was observed on average. Now, in 1998, Russia defaulted. And this was an unanticipated event and led to historical correlations breaking. You had a risk-off event where all assets, now that might remind some people from what's happening recently, but when risk assets fell, and there was a flight to quality, which at that time had not happened to such an extent, and LTCM was not prepared for that, and started selling into the market its assets, which were vast, and that exacerbated the moves, and the Federal Reserve had to step in for this lifeboat operation, which did not involve the Fed using its balance sheet, however, at the time. So the lesson then is to not rely on historical correlations that much, because they might break. And, you know, if you are highly leveraged, not all leverage is bad, I know that. We don't want the stability of the graveyard. You need to stress test your models, and correlations are different during stress than others.
Vicky, I'm afraid to ask why you used this example. You had 28 years, but you chose this. Do you have another one, or we're focusing on this?
Well, I have a more, if I could say.
You don't have to, I'm just kidding.
Yeah, I mean, at the moment, in this particular incident, where of course if you want, the trigger for the shock is government policy in the US, which was unanticipated.
Yeah, you used that word many times, actually.
Last year, so that was the trigger of the shock. The vulnerability, again, is going to be around highly leveraged players, and there are highly leveraged non-banks around. Now, hopefully, some of them have learned the lessons of the crisis, but it is true, and you can read that in the press, in the Financial Times, that at points towards the beginning of this week, for instance, some of these hedge funds were facing margin calls, like LTCM was, and they had to stop, unwind positions, and this sometimes exacerbated market moves. However, so far, because it's not only, they seem to have had the liquidity to pay these margin calls. But this is, of course, a risk going forward. And in particular, we know that there are particular strategies that involve, again, profiting from these small arbitrage opportunities, basis trades, asset swap trades in the technical language, that could be susceptible to that. So it depends on the degree of risk management and the lessons learned, which some of those hopefully have been learned, but we shall see.
Yes, and I was planning to come to my third question to go and dig a little bit about this, but I suspect that as a central banker, you cannot actually tell us what you're looking at, right? It's part of dealing with situations like this. I'm not saying that you are now, but whenever you're dealing with this, you have this weird setup where you can actually not. Even if you've identified something, you cannot really go public about it, because that's the very nature of the beast, right? You don't have to answer this, but I'm just giving you a first shot that when I come to the third question, if we have time, if you're lucky we won't have time, you need to think of how to answer that question.
Yeah.
You don't have to now.
Yeah. No, I mean, what a number of central banks do, and the Bank of Greece actually does it as well, and that was something that they started doing post-LTCM. The Bank of England was the first one to try to do it, as for a long time, but then they do publish so-called financial stability reports. So over there, they do list the vulnerabilities and the systemic risks. So what I have just said about some high leveraged plays in core markets, like government bond markets, is something that both the Bank of England has highlighted publicly, and the Federal Reserve, for example, that has also published these reports. But publishing these reports is one thing. Whether the mitigation lies ultimately with the risk management of the private sector. It's not for central banks to bail out individual companies. It is for central banks to safeguard financial stability overall. Right.
I'll come back to that. There's a question mark on that. But I'll shift to Philippos and shift to the corporate perspective. Similar questions in terms of how financial failures shape future strategy, and what are some lessons learned? Maybe you can help us with some interesting examples there from your experience.
Sure, and I think picking up from where Vicky left, we can discuss an example where both financial players, like hedge funds, affect hedging behavior of corporates. And as you mentioned, Maven advises corporates, typically listed corporates, on interest rates, currencies, as well as metals and energy. And a very good example is the nickel crisis of 2022. So what happened there? Nickel was at $25,000 per ton, and within 2 days it went to 100,000, like 4 times the price. Now, the initial catalyst was Russia invading Ukraine, and Russia was essentially producing 10% of the nickel production worldwide. So this was the catalyst. But there were very large short positions of financial players in the market that started to be forcefully unwound. So the price started going 25,000, 30,000, 40,000, 50,000, and all of these margin calls were essentially not met and positions were closed. Keep in mind that this was such a big event that the London Metals Exchange closed for 5 days on the nickel trading, which was unprecedented. And not only that, they canceled the full day of trades. Now, on our side, we're advising a leading European steelmaker. And on their side, they had put nickel trades just to hedge their physical exposure. Zero speculation. They had just entered into the futures market to protect their inventory. Nevertheless, when this was happening, suddenly they got a call from a bank saying, can you put 50 million of euros as collateral tomorrow? And if you're a corporate, it doesn't necessarily mean, however big you are, that you have the liquidity for 50 million. So from their perspective, one of the very old ISDAs with one of the banks had what we call a threshold, that essentially if a certain level of mark-to-market is reached, you need to post collateral. And that's something that the corporate, the steelmaker, hadn't reviewed for like 10 years. So it came back to haunt them. Big negotiations with the banks. Eventually, everything was sorted out. But I think the lessons learned from this very simple example, liquidity management, so modeling what will happen in your derivatives market, not only on your physical market, and also credit risk. You need to review and make sure that the documents you have with the banks, with the exchange, etc., will not come back and haunt you. There is definitely an improvement on the corporate sector for the last few years. They have better systems, better prepared, but nevertheless, it does take crises like this, and this is only 3 years old. It's very recent.
So I guess another way to put it into perspective is that I could have had a panel like this, and aside from the corporates, the central bank and the private markets, to have actually invited a lawyer or two, because ultimately that's where the action might be, or where things might start breaking down, because either your lawyer is not paying attention, or you have a lawyer and you're not using them as well as you should in terms of checking all the various different corners there. So that's the whole point. I think even with the first two, I guess the one point and I'll come back to that, is that a lot of what you need to do in real time is imagination. You need to somehow cultivate this as much as possible. And with that, I'm going to go now to, specifically in private markets, to private equity, which most people think they know what they do, but we don't really. And we want to understand how do private markets reacted and evolved from financial failures over the last few decades? Any kind of relevant examples that you think are critical to have in the back of our minds?
Sure, and thank you, Yianos, for having us again. I'll try to bring a little bit of that investor and private markets perspective to the panel here. But just to level set, private equity, as the name suggests, what we do is we take equity, ownership stakes in private companies. That tends to be controlling stakes or majority position. And I think the most relevant parts for today's panel are those tend to be illiquid, longer-term positions. So think of 5, 6, 7-year hold periods that are private. So it's harder to sort of think about day-to-day valuation and market risk. Crucially, we take a lot of debt. On our side of the pond, we call it leverage.
You said the bad word.
I know, but and just to put some very simple math around it, if we invest $1 on behalf of our investors, we typically will borrow $2 to $3 from banks or other sources of credit. And so we are taking concentrated bets and we're using leverage, and that becomes particularly relevant at moments of stress in the system. So I know I'm going to tie together a couple of the themes that have already been raised so far by the other panelists. No different than if you're a policymaker, government or corporate, times of financial failures are times opportunities for learning, sometimes painful learning, but learning nonetheless. So even private equity is a relatively young industry over the last 40, 50 years. I think every crisis has shifted a little bit, both strategy, but also how we do our work day to day, including how we work with lawyers. So, Yianos, I think your point is very well taken, and indeed, probably a good segue to a little bit of my own lesson learned, if I was to share. Thankfully, my lesson learned came relatively early in my career, which is why I'm still employed. But it was in the great financial crisis when I think there was a lot of lessons learned. But to tie it back to leverage, we were investing in a company that we were convinced was very low risk. This was a company that moved groceries from warehouses to the stores. The common knowledge or understanding at the time was food is very resilient. It never goes out of fashion. People need to eat no matter what's happening in the macro. And so we took that view, and we spent millions of dollars with the Bains, McKinseys, and I'm not going to say PwC because I see my friend there, but there's a
the
lot
consultants,
of,
the other evil people.
Very smart people.
Sorry, smart.
But what we ended up missing, if I had to distill it down, was two things. One, in a time of crisis, every esoteric risk that you might get comfortable with on a one-off basis, so a customer concentration or some other specific risk, in the end of the day, they're all linked together. And in a moment of crisis, that really stresses the system. And what you really need to survive then is flexibility. No one has a perfect crystal ball, and so you have to build in as much flexibility as you can. That means capitalize the business appropriately, have liquidity, have a strategy operationally and otherwise to adapt to the moving times. And candidly, for us then, we got caught in the wrong moment. Too many of those things started moving, and we don't have time to go into the details right now, at the same time. And the net result of it was ultimately, you could guess how this story ends. It ended up in bankruptcy. But the key lessons learned were how you do the diligence, how you prepare for the worst, how you work with your advisors to do that. And thankfully, those are lessons that continue to prove relevant for better or worse.
Good. So I think it's, as I guess a common theme here is correlations and how they work or they don't work sometimes, and also how after a certain period of time we tend to forget about them too. So there's some cyclical aspect to how things happen. But are there any common themes here? I mean, I want to, and I know that's a hard question to really answer in a very insightful way, but I want to ask it. In real life and in present tense, you're dealing with unknown unknowns. Even if you see something starting to take place, you have to be thinking about the next steps. Is there some sort of a setup where one might be thinking about this? So, and I'll try to make it more specific, Vicky. In terms of crisis, are there any common characteristics that one might have to keep in the back of their minds, especially as a policymaker, that are worth highlighting as general principles?
Yeah, so that's a good question. I think generally, and this is sort of a framework to think about it, it's, the shock needs to be big, so a big and anticipated shock, a little bit like the announcements we had on Wednesday, that could have broad consequences and it wasn't already factored into market prices and plans of people. So that's the source. The second thing is the vulnerability that exists that depends on your business model. So, for example, if you're a bank, you have to be leveraged, right? Because most of your liabilities are going to be people's deposits. You don't have a business model. But the question is, are you over-leveraged? And also, what are you going to get the flightiness of your liquidity resources? Again, if you're a bank and your depositors try to get worried about your capitalization because of what has happened, they can run very, very quickly. And the lesson we learned in March 2023 from the collapse of a small American bank called Silicon Valley Bank was that these runs at the moment can be extremely speedy because of technology and digital payments. So you have to know your vulnerability, which will be different for different business models. So I think private equity funds, for example, and hedge funds tend to lock in their investors, and they cannot fly out as quickly as they could the banks. There, the problem for liquidity usually comes on the margining side. So you need to stress it to have liquid resources to deal with margins, which is what your lenders ask you to give, which increases each time markets are volatile. So it is your leverage and your liquidity and where the liquidity demands have that are very important vulnerabilities, shocks and vulnerabilities. And then the third element is your resilience, which comes from your risk management. So how you have thought about this, including not just being based on what has happened in the recent past and historical correlations and movements, but also what scenario analysis, forward-looking scenario analysis, plausible but stressful things that could happen, do you have the liquidity and the capital to deal with them? This is your resilience. So shock, vulnerability, resilience, and definitely depends on your business model.
Okay. Felipe, are they always sudden, the crisis and the financial failures? Are there any warning signs?
I think there are the ones that you cannot predict, like September 11, COVID, or even the nickel price crisis I mentioned. But I would say most of the crises, they happen in a slow-burning rate. And if you think 2008, we had plenty of warning signs. And I would argue, even what we experience today, with the US administration policies, et cetera, they even told us many months ago they'll do the tariffs, et cetera. So I would say it's taking these warning signs seriously and preparing yourselves. And I think at the beginning, we're just now at the beginning of the next sort of high volatility phase. So people that will not take these warning signs seriously, it's to their own peril. And I think it's a good time to also mention that a crisis is very different depending on who you are. Like a 3% intraday move can be catastrophic for a hedge fund, but it's a blip for a corporate. And that essentially depends on what's your horizon. If you're a hedge fund with a one-week trade horizon versus if you're a corporate with, let's say, a one-year horizon, or to the extreme, given that we have James here, even a 20% move, let's say on FX, over a 10-year horizon is only 2% on IRR terms. So it totally depends on what horizon you're looking at and preparing for that.
So I guess one way to prepare is to have a long horizon, or find to
if
lock.
You can.
Yeah, if you can lock your funding for a long period of time. James, talking about risk and failure and the private equity land, and I'm just going to ask you, I guess, a loaded question a little bit here. One is the theoretical. How do you guys think about the risk of failure, given your type of business, and given the fact that private equity has been one of those successful sectors, right, in the last few decades? Are you a source of risk for the system? Hey, you hadn't prepared for that one, but okay. start from the first part.
Start from the first one.
Yes.
See where we go. And to be clear, when we don't talk to our investors about failure. We use different words, but certainly risk.
We're among friends here.
Risk is undoubtedly part of the understanding and the contract we have with our investors. We're targeting, just to put it in perspective, 20+% returns. Those types of returns don't come without risk, and so there's an understanding that not all of our investments will work out. And if you're investing out of a fund with long-term committed capital, which is admittedly a luxury, especially in markets like this, which we appreciate, it gives you the ability to take a portfolio view and say, okay, there's going to be winners, losers, but on average, we will deliver good, solid, risk-adjusted returns. Interestingly, what the evidence and the academics would show is the biggest differentiator between the performance of funds is how many losers you have. So failure is actually a very costly and it ultimately is the biggest kind of driver of outperformance or not for various funds. And so we, unsurprisingly, spend a disproportionate amount of time on how to think about failure, how to price it, et cetera. In general, pricing risk is what we do. Building blocks, risk-free rate, country rate, macro rate, industry rate, and then the macro risk at the bottom of how you price any deal or any asset for that matter. But it's an interesting question. If you double-click, how do you think about failure and avoiding it, and crucially, how do you build a portfolio around that? It's hard to bring it down to a science. I will share something, though, more tangible, which is to say how we do it at our firm. We align the incentives. So as individuals, if you do a bad deal that goes sideways, you feel the pain too. So and that's different than a portfolio construction. So incentives alignment is an important piece of how you deal with risk. It's a broader, bigger topic, maybe for next year's panel. But right. It comes back to your other question, though, of is private equity in general adding risk to the system? I would say, maybe I'm biased, but I would say the incentives are fundamentally there to protect against that, because as an asset class, you're long-term focused. And the only way you're going to keep raising capital from your investor base is being able to demonstrate on a consistent basis that you were able to manage through risk. And it's not did you take advantage of one dislocation and have upsized returns. It's more how through the cycle you have that continuity. So that would be my sales pitch for private equity.
Very good. Luckily for you, we have less than 5 minutes for maybe the tougher question, even though you touched on it, all of you. And I'm going to start with Philippos on that one. This is being recorded, so the question is, when we talk about the future, right, should we start thinking about financial failures in this particular part of the cycle? What does concern you from a market's perspective? Because that's kind of your job, right? You have to address those concerns, those multiple risks, and how they might interact in a weird way for corporates. What are you mostly concerned about here?
And clearly, we're into a very volatile environment, and I think this will continue for many, many months. Interestingly, I don't think that interest rates will be the source of the problem for corporates.
Because that's what we're hearing yesterday and today. It's the Chinese that are selling bonds, U.S. bonds. They're on the attack. Today, I've heard it's the Japanese that they're doing this, and everybody's looking at the basis rate on fixed income. I see some people still staring at their phones on that. But you're making a pretty bold statement. Not fixed income?
Not fixed income, because it will be volatile. But if you think about it, the corporates, they've dealt with 0 rates to 5 rates, back to 0, et cetera. So I think they're well prepared. The area that is more concerning for me is currencies, and particularly if the dollar, the reserve currency status, starts losing its appeal, huge issue. You can see 20, 30% moves. And then on the commodity side, metals, both with supply chain dislocations, but also the push on defense globally, right? And lastly, medium-term to long-term, energy. As AI is taking off, AI is a huge consumer of energy. So I would say, FX, metals, and energy would be my biggest concerns from a corporate dislocation.
Got it. And from your perspective, James, I'm leaving the central banker at the end, just to save her, so she doesn't have to say anything potentially, frightening. You're a long-term investor. Do you care? Why do you care about 2025?
We do care. I mean, we care for 2 reasons. One is we have an active portfolio. So we've already have a significant amount of capital invested on the ground that we need to help support, monitor, and grow. So we spend a lot of our time on the portfolio. Some of that also creates opportunities, mind you, to invest. So if you think about times of dislocation and where can we invest new capital, the first place to look is in our existing investments, because you could try to take advantage of opportunities that present themselves there. In general, market... So
you're self-correcting, right? You bring new money in and you correct.
Well...
That's another great advantage.
I would put a different spin on it, but yes.
Yes, okay.
But the reality is the market activity level comes down because it's very hard to price assets. It's very hard to reach an agreement between buyer and seller in this market. So what we end up doing and others is in times like this, we still need to invest. Our investors give us money to invest in good times and bad. We don't get to go to the beach for a couple of months and come back. We have to try and find ways to invest. And so what you try to do is, how can you find creative ways to do risk sharing, do partial recaps, ways that you can somehow bridge the gap of seller-buyer mindset from a valuation perspective and risk sharing.
Thank you, James. Last but not least for sure, what concerns you most nowadays?
Well, I mean, in my current role, where I'm responsible for the markets function of the central bank, which means kind of managing the balance sheet, being responsible for its lending facilities, and also speaking with market participants all the time. Clearly, the market movements that are going on are central. I mean, I love coming to this forum, but its timing this year has been a bit challenging, given the developments. So that's what concerns me. I am glad that we did learn the lessons from the GFC, and the banking system, which is a source of systemic risk traditionally, is in a much better condition in terms of resilience.
Great.
In the UK banking system, and mostly the international banking system. I know the idiosyncrasies we have in Greece, where we're making improvements. So that is a source of concern, is a source of optimism, in terms of that the banking system I talked about resilience, has much better liquidity positions and much better capital than before the crisis.
You have 10 seconds left to scare them if you want.
And the other thing is, despite the fact that the movements were very large, not as large as we saw in the dash for cash in the pandemic in 2020, but large, the market infrastructure, and you run a market infrastructure, Yianos, helps.
Much more robust. Yes.
Is more robust. So these are the sources of optimism. The source of pessimism is that we are in a world that we haven't seen in the historical data, arguably since the 19th century,
So
or the early 20th.
Business as usual then.
And therefore, to what extent this has been incorporated into firms' risk management is about to be seen.
We'll find out. Well, on that happy note, I want to thank you all, and also invite Ms. Andriana Paraskevopoulou for the next panel. Thank you all. See you soon.